Premium tax credit is the refundable credit you claim on the return. Advanced Premium Tax Credit, or APTC, is the same credit paid early to your insurer to lower monthly premiums. On the EA exam, they love this distinction. APTC is not extra money. It's an advance that gets reconciled on the return using Form 8962. Here's the big gatekeeper rule. The credit is marketplace only. If the policy wasn't purchased through the federal or state marketplace, no premium tax credit. Not through an employer plan. Not bought directly from an insurance company. When you see a fact pattern, your first question should be, was it marketplace coverage? To qualify, you generally need to check several boxes. You must be a U.S. citizen or lawful resident. You can't be eligible for other qualifying coverage like Medicare, Medicaid, TRICARE, or similar government coverage. You also can't be claimed as someone else's dependent. And if you're married, you generally must file jointly. Married filing separately usually kills the credit. Filing status is a classic trap. Married filing separately generally disqualifies you from PTC and APTC. The exam may hint at narrow exceptions like spousal abuse or abandonment, but the default rule is simple. Married means filed jointly for the credit. If you see MFS in the answer choices, treat it like a red flag unless an exception is clearly stated. Now the employer coverage and COBRA Trap. If the worker voluntarily enrolls in an employer-sponsored plan, including COBRA or retiree coverage, that worker is not eligible for the premium tax credit, even if the employer plan is unaffordable or doesn't provide minimum value. That's a brutal rule, and it shows up on exams because it feels unfair. But there's an important family member exception. One person's employer or COBRA enrollment can block the credit for that person, but it doesn't automatically block everyone else. If another family member is on marketplace coverage and is not enrolled in the employer plan, that family member may still qualify for PTC. The exam loves splitting eligibility by person and by month. Use the Weston and Debbie style analysis. Eligibility can change mid-year. Weston gets a job with employer coverage, so he may only qualify for PTC for the months before that coverage applies. But his dependent daughter can still qualify for the full year if she stays on a marketplace plan and isn't eligible for the employer plan. Always think who, which months, and what coverage. Dante is the sole support of his mother, Marina. To claim her as a dependent on his Form 1040, Marina must be a citizen or resident of which countries? The options include only the United States plus Canada, the United States plus Mexico, or the United States plus both Canada and Mexico. Think about it. The correct answer is the United States, Mexico, or Canada. For dependency, the person must be a U.S. citizen, U.S. national, U.S. resident, or a resident of Canada or Mexico. A tempting wrong choice is United States only, because that sounds intuitive, but Canada and Mexico are explicitly allowed. Each of the following individuals are automatically taxed as residents of the United States, except one. The choices include a non-resident alien who marries a U.S. citizen during the year, a green card holder who leaves before year-end, someone physically present for 365 days without a visa, and a green card holder living outside the U.S. Which one is the exception? Think about it. The exception is the non-resident alien who marries a U.S. citizen during the year. Marriage alone doesn't automatically make them a U.S. tax resident. They're treated as a resident only if the spouses make a joint election. The tempting wrong answer is a green card holder living abroad. But a green card generally makes you a resident for tax purposes.